You spend hours on this platform most weeks. So does almost everyone you know. In 2025, YouTube generated more than $60 billion in revenue, more than Netflix's $45 billion, more than most film studios could produce in a year combined. That number sits underneath every video you've ever watched, every ad you skipped, every subscription you paid for without checking the price first. Most people assume Google keeps the bulk of that money, and creators split whatever's left over. The actual arrangement is far more specific than that, and once you see the mechanics, you won't watch a monetized video the same way again. By the end of this video, you'll know exactly where every dollar of ad revenue on this platform goes, why a channel with 1 million subscribers can still be losing money, and why Alphabet keeps pouring billions into a business that runs on thinner margins than almost anything else the company owns. This is the economics behind YouTube. Most people describe YouTube's business model in one word: ads. That's accurate, but it only covers half of it. At the start of 2026, Alphabet broke YouTube's total revenue out as its own reported line for the first time, covering the full 2025 fiscal year. The number, over $60 billion, built from two separate revenue engines running side by side. The first is advertising. In 2025, YouTube's ad revenue crossed $40 billion, up from $36.1 billion a year before, growth of roughly 12% in a single year. The longer trend behind that number is even sharper. In the fourth quarter of 2022, YouTube generated $7.96 billion in ad revenue. By the fourth quarter of 2025, that figure had climbed past $11.3 billion, an increase of more than 43% in 3 years, even while YouTube kept rolling out formats like Shorts that were never designed to earn at the same rate as long-form video. The second engine gets far less attention, and by 2025, it had become the faster-growing of the two. Subscriptions, meaning YouTube Premium, YouTube Music, YouTube TV, and NFL Sunday Ticket bundled together, brought in somewhere around $20 billion that year. Add that to the ad number, and subscriptions made up close to a third of everything YouTube earned. By the fourth quarter of 2025, Alphabet reported more than 325 million paid subscriptions across its consumer services, a figure driven heavily by YouTube's own premium tiers. Two businesses, one platform. One sells attention to advertisers. The other sells an ad-free experience and live television directly to viewers. Together, they made YouTube a bigger annual revenue generator than Netflix, a company that spent 2 decades building the entire streaming category YouTube, then walked straight into. A single view on YouTube carries no fixed value. It's worth whatever an advertiser was willing to pay to reach that specific viewer at that specific moment, which is a very different number from video to video. Advertisers bid for ad space through an auction, similar in structure to how Google search ads get sold. The price is usually described using CPM, cost per 1,000 impressions, how much an advertiser pays to show an ad to 1,000 viewers. A finance channel explaining investment products can command a far higher CPM than a gaming highlight reel, because the advertiser bidding on that finance audience is often selling something with a much higher price tag, like a brokerage account or a credit card. The viewer is the same person scrolling the same platform. The advertiser behind the ad is paying for intent, not attention. Geography changes the number again. An advertiser targeting viewers in the United States, Australia, or the UK typically pays a meaningfully higher CPM than one targeting viewers in markets with lower advertising budgets, even for the exact same video. Two channels with identical view counts, one skewed toward a high-spending market and one skewed toward a lower-spending one, can end up with wildly different revenue despite matching audience sizes. Live content adds another layer entirely. Sports, in particular, command some of the highest ad rates on the platform, part of why Alphabet paid for NFL Sunday Ticket distribution rights, and why a single Chief Chargers broadcast on YouTube in September 2025 pulled in more than 19 million viewers worldwide, the platform's largest concurrent live stream audience to date. An audience watching live, unable to skip the ad, is worth far more per viewer than the same person watching a random video on their own schedule. Creators don't see the CPM number directly. What actually lands in a creator's account is RPM, revenue per mil, the amount paid out per 1,000 views after YouTube's cut, and after accounting for videos where no ad played at all, or where the advertiser only paid for part of the view. A video with 1 million views and a healthy CPM can still post a modest RPM if a large share of the audience skip the ad within the first 5 seconds, because plenty of ad formats only pay out once a viewer watches past a certain point. A view functions as the outcome of an auction, filtered through geography, niche, and viewer behavior, long before it turns into a number a creator can actually spend. A meaningful share of the money that flows through YouTube comes from videos the earner never actually uploaded. YouTube runs an automated system called Content ID, which scans every new upload against a massive database of copyrighted audio and video submitted by rights holders, record labels, movie studios, publishers. When Content ID finds a match, the rights holder gets to choose what happens next. Block the video, track its performance quietly, or claim the ad revenue for themselves, even though someone else made and uploaded the video. This is a huge, mostly invisible slice of the platform's economy. A song playing in the background of an unrelated video, a few seconds of a movie scene inside a reaction video, a licensed soundtrack running under gameplay footage, all of it can trigger a claim. The uploader keeps the video live and keeps their subscriber count and watch time. The ad revenue on that specific video routes to the rights holder instead. This is a major source of the $8 billion paid to the music industry in a single 12-month stretch through 2025. A large share of that total traces back to claims placed across millions of ordinary creator videos that happen to include a few seconds of a copyrighted song, detected automatically, at a scale no human review team could manage on its own. For creators, Content ID is the tax nobody explains clearly when they upload their first video. A video can rack up 1 million views and generate real ad revenue, and the creator might never see a cent of it if a short unlicensed clip triggered a claim somewhere inside it. It's a second monetization system running underneath the one everyone already understands, quietly moving money away from the person who made the video and toward whoever owns the fragment of content sitting inside it. Advertising revenue doesn't stay entirely with Google. A fixed share of it goes straight to whoever made the video, and that split has stayed remarkably consistent for well over a decade. For standard, long-form video ads, YouTube keeps 45% and pays 55% to the creator through the YouTube Partner Program. Scale doesn't change the ratio. A channel with 10 million subscribers keeps the same 55% as a channel with 10,000. Scale just multiplies that same cut across more views. Shorts work differently because a 15-second vertical video can't carry the same ad load as a 10-minute explainer. YouTube pools all the advertising revenue generated across the entire Shorts feed each month, pays out music licensing costs first, then splits what remains among eligible creators based on their share of total Shorts views that month. It's a shared monthly pool rather than a per-video payout, part of why Shorts monetization has historically paid less per view than long-form video. To qualify for either pool, a channel has to clear the Partner Program's bar, roughly 1,000 subscribers and 4,000 watch hours over the past 12 months for long-form content, or the Short-specific view threshold as an alternative path. Most channels that start on YouTube never clear it. Add it all up, and the total gets enormous fast. In September 2025, YouTube announced it had paid out more than $100 billion to creators, artists, and media companies over the previous 4 years. The payout is the business model. Long before individual creators had built-in tools for analytics, copyright management, and brand deal facilitation, a layer of companies called multi-channel networks inserted themselves into the middle of this economy. Networks like Maker Studios and Machinima signed up thousands of channels through the early 2010s, offering things creators couldn't easily get on their own. Better ad rates through bulk negotiating power, production support, and access to brand sponsorship deals. In exchange, these networks typically took a cut of a creator's ad revenue, commonly somewhere in the 20 to 30% range, stacked on top of whatever YouTube itself had already taken. For a few years, that trade made sense. YouTube's own creator tools were thin analytics were basic, and finding a sponsor without an agent or a network behind you was genuinely difficult. Disney bought Maker Studios for close to $500 million in 2014, a signal that a major media company believed these networks were becoming the new talent agencies of the internet. Then YouTube built the tools the networks have been selling. Detailed analytics arrived natively inside YouTube Studio. Copyright and content ID management became something a channel could handle directly. Brand deal marketplaces and creator-facing sales teams started forming inside YouTube itself. Every service and network used to justify its cuts slowly turned into something a creator could access for free straight from the platform. Many of the largest networks were shut down or folded into other businesses within a decade of their peak. The lesson sits underneath almost every layer of this platform's economics. A business inserting itself between a creator and their revenue only survives as long as it's solving a problem YouTube hasn't solved yet. The platform has consistently absorbed those functions itself over time. Part of why an individual creator today can run a seven-figure business with a laptop and a camera without a network or an agency standing between them and their audience. So, quick ask before we keep going. If this kind of breakdown is useful to you, go ahead and subscribe. It genuinely helps the channel grow, and it means the next one lands in your feed the moment it's out. Ad revenue is the number everyone talks about, but for a channel doing real business, it's rarely the largest line on the income statement. Once a creator has an audience, the ad split covered in the last segment is only one revenue stream among several, and it's often the smallest one for a channel above a few 100,000 subscribers. Channel memberships let viewers pay a monthly fee, usually a few dollars for badges, custom emojis, and members-only posts, and YouTube takes the same 30% cut it takes on most in-app purchases across the platform. Super Chat and Super Thanks let viewers pay to have a comment highlighted during a live stream or to tip on a regular video, running through that same revenue share structure. YouTube Shopping lets creators tag products directly under a video and earn a commission on anything purchased through that link, turning a video into a functioning storefront without the viewer ever leaving the page. Layer a merch shelf underneath a channel's videos, and physical products become another line of income running independently of any of it. None of those come close to the largest external stream. Brand sponsorships negotiated directly between a creator and a company, where YouTube takes no cut at all. A single sponsored segment inside a video, usually 60 to 90 seconds placed mid-roll, can pay more than months of ad revenue for a mid-sized channel. For a channel with millions of subscribers, one sponsorship deal can be worth six figures on its own, paid entirely outside YouTube's revenue share system, negotiated directly or through a talent agency that takes its own separate cut. The platform's own cut of the money is often the least important piece of a successful creator's income. Advertisers pay YouTube. Brands pay creators directly. Both checks can trace back to the exact same video, and only one of them ever touches Google's books. Getting paid and getting rich are not the same thing on this platform, because production costs scale right alongside revenue. A creator filming on a phone in a bedroom carries almost no overhead. A creator running a studio, an editing team, and elaborate physical sets is spending a huge share of every dollar earned just to fund the next video. Mr. Beast is the clearest example of this at the extreme end. Public reporting put his 2024 earnings around $85 million, more than almost any other individual creator on the platform. He has also spoken openly about reinvesting the overwhelming majority of that revenue straight back into production. Elaborate sets, large cash prizes, big crews, all aimed at making the next video outperform the last one. The ad revenue and sponsorship money don't sit in a bank account. They fund the next video's budget before that video is even filmed. That reinvestment model only works if the channel keeps growing, because production costs at that scale don't shrink just because one video underperforms. It's a business built on the assumption that this month's output has to beat last month's indefinitely, or the entire cost structure stops making sense. Smaller creators run the same calculation on a smaller scale. Better cameras cost money. editors cost money, and every upgrade eats into a margin that was already thin to begin with. A creator earning a comfortable, full-time income from ad revenue alone can still be one algorithm shift, one slow month, or one cancel sponsorship away from a serious cash flow problem, because so much of what came in already went straight back out the door. Subscriber count alone tells you almost nothing about a channel's actual profitability. 1 million subscribers with high production costs and inconsistent sponsorships can net less than 100,000 subscribers running lean, with reliable brand deals and editing handled in-house. Revenue and profit are two completely different numbers on this platform, and only one of them ever shows up on the subscriber count. None of this plays out evenly across the world, and that unevenness shapes what actually gets made on this platform. Advertisers spend far more per viewer in the United States, the UK, Canada, and Australia than they do across most of the rest of the world, because those are the markets with the highest consumer spending power and where advertisers are chasing the most valuable purchases: cars, financial products, software subscriptions, healthcare. A channel built around an audience in South Asia or Latin America can post view counts that dwarf a comparable English-language channel targeting North America, and still earn a fraction of the ad revenue, purely because of where those views originate. This is a large part of why so many creators outside English-speaking markets eventually pivot toward English-language content, or toward topics that specifically attract advertisers with global budgets, like technology, finance, and business news. Their original audience often keeps watching. The platform's economics simply pull the incentive toward the more valuable audience instead. The same dynamic explains why so much of YouTube's most heavily monetized content clusters around a narrow set of topics: personal finance, technology reviews, business breakdowns, self-improvement. Raw view count alone would point toward comedy, gaming, and general entertainment as the platform's biggest earners. The advertiser sitting behind the ad tells a different story, paying the most for a slice of attention in exactly the categories listed above, and that gap in advertiser demand is what actually pulls creators toward these topics over time. Giving away 55% of your main revenue stream and 0% of the secondary one sounds like a strange business decision from Google's side. The full answer sits one level up, inside Alphabet's entire portfolio of businesses. YouTube's ad revenue alone made up close to 10% of Alphabet's total quarterly revenue by the end of 2025, at a company that also owns Search, Android, Google Cloud, and Waymo. That's a meaningful chunk of the business on its own. The larger driver behind the investment is where attention is moving. Nielsen data from mid-2025 showed YouTube capturing a bigger share of total television viewing time in the United States than any other platform, streaming or broadcast, ahead of Netflix. Living rooms are becoming YouTube's biggest growth frontier, exactly why Alphabet pushed hard into NFL Sunday Ticket, YouTube TV, and connected television ad formats over the past few years. There's also a defensive layer to the spending. Short-form video became a genuine battleground the moment TikTok and Instagram Reels started pulling attention away from longer sessions, and Shorts exist largely to make sure that attention has somewhere to go without leaving Google's ecosystem entirely. Alphabet is willing to run Shorts at a lower rate per view than long-form video, specifically because losing that screen time to a competitor would be far more expensive than subsidizing it. Every dollar Alphabet spends expanding YouTube buys something Search and Cloud never could on their own: a direct foothold in television advertising, the largest ad category Google has never fully owned. Netflix spent 2 decades and tens of billions of dollars building an audience from nothing. YouTube already had one, built for free by millions of creators uploading content the platform never had to produce or pay for upfront. That 55% split works out to be one of the cheapest content acquisition deals in media, and Alphabet knows exactly what it's buying with it: a content library it never funded, an audience it never had to build from zero, and a growing foothold in television that would otherwise cost billions to acquire from scratch. Every number in this video so far describes the top of the platform: $60 billion in company revenue, $100 billion paid to creators over 4 years. $85 million for a single creator in 1 year. None of that describes what happens to the overwhelming majority of channels that upload to YouTube. The partner programs bar, 1,000 subscribers and 4,000 watch hours, sounds small next to a platform with billions of logged in monthly users. In practice, most channels that start on YouTube never clear it. Millions of channels exist that have never earned a single dollar from advertising because they never crossed the eligibility line in the first place. Millions more clear that line and still earn amounts too small to matter, a few dollars a month spread across a handful of videos. The creator economy on YouTube runs on a power law, the same shape that shows up in venture capital returns, book sales, and music streaming. A small number of channels absorb a disproportionate share of the views, the sponsorship deals, and the ad revenue, while the long tail of channels splits what's left across millions of accounts. The pattern comes directly from how the algorithm rewards watch time and audience retention. Attention concentrates around a small number of channels instead of spreading evenly across all of them. Somewhere in the middle sits the largest group of all, channels that clear the partner program bar, post consistently, and earn something real, a few hundred to a few $1,000s a month, without ever reaching the sponsorship tier or the production budgets covered earlier in this video. For a lot of creators, that middle tier simply is the destination. It runs like a small local business, steady, unglamorous, and entirely dependent on showing up on a schedule. The very top layer keeps expanding even as the bottom stays crowded. YouTube reported that the number of channels earning more than $100,000 specifically from TV screen viewing grew 45% year-over-year heading into 2026, driven by the same living room shift covered a few minutes ago. Growth at the top and stagnation everywhere else are two views of the same trend, seen from different altitudes. Understanding this changes what starting a YouTube channel actually means as a financial decision. Financially, it functions like launching a small media business. Almost all of the downside risk sits with the creator, and almost all of the upside concentrates in the small percentage of channels that break through. YouTube is one platform out of thousands of companies running on numbers just like these, hidden behind a product people use every day without ever seeing the business underneath it. That's exactly why this is becoming a series. The economics behind anything. Netflix, Apple, Amazon, your bank, the app you're watching this video on right now, any company you've ever wondered about is fair game. Drop a comment with the company or platform you want broken down next, the same way we just broke down YouTube. If enough people ask for the same one like Netflix, that's the one that gets made next.